Welcome to RP Data's update on Australian housing market conditions for August 2012. Last month we saw Australian capital city dwelling values rise by 0.6% following a June rise of 1%. If we do see a further rise in August, it's a likely sign that we're starting to see the Australian housing market enter into a recovery. The July rise follows a 1% lift in capital city values over the month of June and brings the cumulative decline in values over the first 7 months of 2012 to slightly less than a 1% fall at negative 0.6%. It's important to note that the July rise wasn't as broad-based as what we saw in June. The lift was almost entirely due to a 1.2% increase in Sydney values over the month and a 1.4% rise in Melbourne. Darwin also recorded an increase. However, due to Darwin's small market size relative to the other major capitals, it has less than a 1% bearing on the overall weighting of the combined capitals index. At the combined capital city level, there was little difference between the growth rate between houses and units. House values rose by 0.6% over the month, while unit values were up by 0.7%. Looking at the trend between houses and units over the past year, it's clear that unit markets have been outperforming detached houses. House values are down by 2.6% over the last 12 months, while unit values have fallen by a smaller 1.6%. Rental rates are continuing to rise, albeit at a fairly sedate pace across most of the capitals. The combined capitals benchmark saw weekly rents rise by 3.3% over the first 7 months of the year. Every capital city, apart from Hobart and Adelaide, has seen a rise in rental rates over the year to date. The largest increases can be found in Perth and Darwin, where weekly rents are up by 13.7% and 5.4% respectively so far this year. Other indicators are also pointing in the right direction. The total number of properties being advertised for sale has shown a reduction and fewer new listings are being added to the market. We are now monitoring just under 296,000 homes for sale nationally, which is still higher than a year ago, but it's about 9.2% lower than the peak number recorded in November last year. Homes are selling faster, vendors are reducing their initial asking prices by less, and auction clearance rates have also shown some improvement. Sydney dwelling values are up by 1.2% in July, following a 1% increase over the month of June, and over the first 7 months of the year, Sydney home values have risen by 1.7%. That's the strongest result across the major capital cities. Sydney's resilience to value falls and early signs of recovery can partly be attributed to the weaker long-term growth cycle. Over the past decade, Sydney dwelling values have increased at the annual compounding rate of just 3.1%. Other factors contributing to Sydney's relative robust conditions include tight vacancy rates, which are pushing up rental rates, rental yields, which are slightly above average, and tight housing supply. The number of homes for sale across Sydney has remained at about normal levels compared to the 5-year average. Melbourne's housing market has surprised on the upside now for 2 months running. Dwelling values are up by 1.4% in July and 1% in June, which is a dramatic turnaround from previous month-on-month results. Since Melbourne's housing market peaked back in October 2010, Melbourne values are down by 8.3%, highlighting the fact that Melbourne's path to recovery is going to take more than a few months of positive results. Despite the previously weak readings, Melbourne dwelling values remain 42% higher than they were at the beginning of 2007. Melbourne's rental markets are looking pretty soft at the moment, with vacancy rates trending upwards since early 2008. According to the REIA, Melbourne's vacancy rate is currently at 2.3%. The major barriers to a Melbourne recovery remain the large number of properties currently being advertised for sale, the low number of transactions in the marketplace, and rental yields, which are by far the lowest of any capital city. The Brisbane housing market saw another fall in values over the month of July, down 0.2% after values rose by 1% over the month of June. The rate of decline across the Brisbane market is moderating though. We are actually seeing a rise in Brisbane dwelling values over the quarter, and over the rolling 12-month period, the trend is moving in a positive direction. Brisbane rents are continuing to plod higher, up by 2% over the year for houses and 1.7% for units. We do expect further upwards pressure on Brisbane rents, particularly when you consider vacancy rates are down around the 1.7 mark. The number of home sales across Brisbane has fallen away since the March quarter. However, we are expecting sales are likely to rise over the second half of the year as conditions improve further and stamp duty concessions for first home buyers become active. The City of Adelaide's recorded the weakest performance of any capital city over the month of July, with values down by 2.5% over the month and 2.3% over the quarter. Since values peaked across the Adelaide market, they've fallen by 8%. Transaction numbers were tracking about 12% below the 5-year average in May, which is a relatively resilient result compared to the other capital cities. Adelaide rents are looking fairly flat though, with house and unit rents rising by less than 1% over the past 12 months. Despite a fall of 0.5% over the month in Perth and a 0.3% fall over the 3 months to the end of July, the longer-term trend in Perth is continuing to show a recovery is underway. Dwelling values are down by just 0.8% over the past 12 months, and rents are racing upwards to the tune of about 10% over the past year as vacancy rates move lower. Perth is the only major capital city to see a consistent upswing in the number of dwelling transactions, highlighting the burgeoning level of demand that is becoming apparent across the Western Australian capital. The strong rental growth also indicates there is no shortage of housing demand in Perth. With sales volumes improving, Perth should be one of the markets to watch over the coming months. Hobart values are down 5.9% over the past 12 months, with falls mostly being concentrated in the detached housing market rather than units. House values were down by 6.4% over the 12 months to July, while unit values showed a smaller 1.1% fall over the year. Hobart rents were down 2.2% for houses over the 12 months to July, while unit rents remained flat over the year. The number of house and unit sales across Hobart looks to be stabilising, which is a positive sign. However, based on our estimates from May, the number of sales in Hobart was about 27% lower than the 5-year average. Darwin's housing market is once again the hottest in the nation. The quarterly result of a 3.2% capital gain was the highest of any capital city, and so far this year, dwelling values have increased by almost 9%. Similar to Perth, transaction volumes are showing some consistent increases, as are rental rates, which are up about 10% for houses over the year and about 8% for units. Rental yields are well and truly the highest of any capital city at 5.7% and 5.9% for houses and units respectively. The housing market in Canberra recorded a 0.5% fall over the month of July, and values have remained unchanged over the 3 months to July. Together with Sydney, Canberra home values have been relatively resilient to any correction. Since the market peaked in July 2010, values have fallen by 4.7%. In a picture similar to Melbourne, the Canberra housing market is facing a scenario of lower transaction volumes and a significantly higher number of homes available for sale. Transaction numbers are trending downwards, and our estimate to May shows the number of sales was about 22% below the 5-year average. Total listing numbers are now about 40% higher than at the same time last year. Overall, I think we're starting to see some green shoots, not just across the Australian housing market, but also other economic indicators. The 2 consecutive months of capital gains across the combined capital cities is potentially foreshadowing a recovery is underway. However, we did see 2 months of growth in February and March earlier this year, followed by negative results in April and May. A 3rd month of capital gains in August is likely to provide a better indication that a recovery is in fact in progress. Other factors are suggesting that lower interest rates are starting to have some flow-on effect. Retail sales were up by 1% in June. Dwelling approvals recorded a stronger than expected result in June and have risen by more than 10% over the year. Inflation is tracking at the low end of the Reserve Bank's target range, providing some wiggle room for interest rates to move lower if required. Population growth into Australia is increasing on the back of higher overseas migration, and consumers are showing some tentative signs of improving confidence. High listing numbers remain a key barrier to a broad-based market recovery. RP Data was tracking about 296,000 properties available for sale across the country over the last week of July, which is about 9% higher than at the same time last year. With the spring selling season around the corner, we're likely to see a rise in new listing numbers. If we don't see a commensurate improvement in buyer numbers, it's reasonable to expect that total listings will rise further. This may in turn dampen any sustained recovery in the housing market. In balance, there is scope for 1, maybe 2 more rate cuts over the remainder of the year. At least that's what financial markets are betting on, based on the interest rates futures market. Lower rates are already having some effect on improving conditions, and the prospect of a stable interest rate environment, or even rates going lower, is going to have a further positive impact on housing market conditions. An interesting question we received this month comes from Jennifer in Byron Bay. Jennifer is a long-time renter at Byron and is wondering if now is a good time to be buying in the local market now that there have been some serious price reductions. Jennifer, you're right. Byron Bay, and for that matter most of New South Wales' northern coastline through to the Gold Coast, has experienced a material correction in home values. Across the Byron Shire, house and unit prices are both down by about 14% from their peak, so it's clear that prices have moved within reach of a greater proportion of the population. A typical buy-in house, though, still costs about $515,000 and the median unit price is a lower $410,000. If you have a 10% deposit and take on a variable mortgage rate at the current interest rate of about 6.8%, you'd be looking at monthly principal and interest repayments of about $3,540 or $884 a week. On the same parameters, a unit mortgage would cost you about $704 a week. As a comparison point, typical rents are sitting at $460 a week for a buy-in house and $420 a week for a unit. Clearly, renting is going to be a cheaper option based on these figures. Your decision really comes down to whether or not you're willing to pay more for the benefits of owning your own home. Best of luck with your decision. As always, thanks for your interest in RP Data's housing market update. You can keep track of market conditions from a day-to-day and week-to-week basis by following the RP Data RISMark Daily Home Value Index at www.rpdata.com or on the ASX website. The index is also available via Bloomberg and Reuters.